Happy Geico Camel Day, guys. It is Hump Day Wednesday. We are midway through the week almost. Hope everybody is doing well. Markets came out of the gate today, shot up again like a cannon. They've given up a good portion of the gains. S&Ps are almost back down towards the flat line, slightly in the green. NASDAQ is just ticked negative for the day. The Dow is still up handily. You got a few stocks that are really making up all those gains in the Dow. How is everyone doing today? Can you hear me? Mike, that's right. Happy Hump Day. Can you hear me and can you see me okay? Yes, thank you. Smash away. Appreciate that. Awesome. And just a little housekeeping for the rest of the week, just to let you know what's going on. Tomorrow, we're going to have Howard Greenberg on here talking about the crypto space with crypto, Bitcoin, Ethereum, just absolutely rocketing, getting back towards all-time highs. The crypto space is active. It is busy. Howard will be here discussing that tomorrow. And then on Friday, I will be live down on the floor of the CBOE back in the S&P 500 pit, and I will have a special guest with me, Henry Schwartz, who is the Vice President of Derivatives for the CBOE. He is going to talk specifically about zero DTEs, volume, things that are going on in the option world, and that will be live. So that is going to be fantastic on Friday. Oh, what are your options? Awesome. All right. So let's take a look. How many of you had this car or knew about this car back in the day? It was pretty darn popular, that's for sure. Rocky Mountain, BMNR, is that what you wanted to look at? If we have time, we will take a look a little bit later on. Yeah, that is, David, you had the same one, huh? I remember my neighbor right across the street from me growing up had that in a really ugly orange color. But yeah, that is the Chevy Vega. We're not going to talk about Chevy today. Better than the Nova. Yeah, I never understood, Kevin, why Chevy had a car called the Nova when in Spanish that means no go. So I never understood that one. But we're going to talk about Vega and options trading. Okay. And why is it so relevant? Why do we always keep an eye on it? And why do we really need to understand it? Okay. So number one, market sentiment. Number two, it helps us with our option selection. Number three, and we're really going to discuss this. What is Vega's impact on option premium? And how do we use Vega in our spreads, in our hedging strategies? Okay. And then we've got to look at that Vega as the market is changing. And especially now with the VIX at its low point that we have seen this year, under 15, boy, how do you use Vega to adapt to these types of conditions? So the way that I was taught and the way that I teach people to remember what Vega is, okay, and it's one of the Greeks that's out there, is we think about Vega and implied volatility. So V and V, volatility, Vega, okay? So implied volatility, uncertainty, they're directly correlated, okay? We know that, right? Implied vol is an annual representation of expected stock price movement. And that is with, as we always talk about, this, right? What is that? A lousy aluminum block engine. That's it, Pete. Yeah, but that's why the car probably cost about $3,000 back in the day. What is this? What did I just draw on here? Maybe not too well, but yeah, Kevin, this is the bell curve. This is a bell curve. So when we talk about implied volatility and we're talking about that expected price movement, that is with a 1 standard deviation measurement, which is 68% probability. Okay. Now, if we were to look at an implied volatility, just generically, 20% on a $100 stock. Okay. What that implies is pretty easy math. A $20 expected move over the next year. So a range, remember, implied vol and then expected move, it doesn't guide us directionally bullish, bearish. It just tells us or guides us to the magnitude of the move. So implied vol at 20% on a $100 stock, that implies a move or a range of 80 to 120 over the next year. Okay. Now, how much does that implied volatility affect option prices? That's what VEGA tells us. Okay. So just like everybody pretty much knows what delta is, right? Delta represents the change in the value of an option as the stock changes a dollar. VEGA tells us the change in the price of an option as implied volatility moves 1%. Okay, 1%. So we will look at some examples here. Okay, we will look at some examples here. And especially, it's not what we're seeing right now in the marketplace, but certainly a few months ago when there is heightened uncertainty, when the VIX is back in the mid-20s or 30 or higher, okay, VEGA becomes more pronounced in an options price, okay? And we need to understand what that VEGA is. We need to understand how it affects our option pricing, okay? So important. So again, market sentiment. Okay, doom and gloom, buy the dip, sell the rip. Do we want to be long or short VEGA? Okay, we talk about that all the time. That really, really comes into our conversations when we are determining, okay, what type of position to take. How does your VEGA affect the P&L of your position? And what are different strategies for different trading climates? Okay, so let's look at some real live examples here. Okay, VEGA is the highest for an option that is at the money. The further you move away from where a stock is trading, the lower the VEGA is. VEGA also declines as you get closer and closer and closer to expiration. Okay, so the more time to expiration, the more VEGA, the more volatility sensitivity an option has. Okay, so again, VEGA is the Greek that measures an option's sensitivity to implied volatility, and it is the change in the price of an option for a 1-point change in implied volatility. Okay. Now, when we talk about implied volatility, rarely do you ever hear me say, or maybe anyone else, NVIDIA is trading at a 38%. We'll say it's trading vols 38. Apple's 21. Okay, same thing. It's always a percentage term for implied volatility. Okay, but we got to be careful and not confuse the two. We can't confuse volatility with VEGA. Okay, volatility is the expected movement of the underlying stock. Okay, VEGA is that measurement, is the sensitivity of an option price to a change in implied volatility. Okay, so for example here, if the value of an option is $7.50. Okay, and let's see if I can scribble this in yellow up here. Let me make this a little bit thicker, actually, hopefully not too thick. So let's say we have an option that is worth $7.50. Okay, IV of 20% and VEGA of 0.12. Okay, that means for every 1 percentage point move in implied volatility, the price of that option will change by 12 cents. So if vol moves from 20 to 21.5, so vol increases 1.5 points, the option price is going to increase 1.5 times 12, or a change of 18 cents. That new pricing would be $7.68. It is that simple. It is that simple. Does VEGA indirectly impact delta? Not really. Not really. Implied vol does, but not VEGA. Okay, what are your options? Okay, got it there. Okay, so literally, it's just a mathematical equation. But we need to understand that, especially when we get into earnings and the vol crush scenarios that we talk about all the time. Okay, so when we look at different strategies that we trade, okay, we look for long VEGA versus short VEGA. Okay, so how do we know what type of strategy to put on? Well, we look to see the implied volatility charts. Okay, and when vol is really, really low, we want to own VEGA. We want to be long it, because if vol moves up, the value of our option is going to move up as well. Okay, when vol is really, really expensive, we would rather be short VEGA, because if vol comes down, the value of that option will decrease as well. Okay, so typically, what types of spreads do we like to put on in a very low volatility environment? Okay, and you know these are my go-tos. It's the type of positions that I like the most. So what types of positions when vol is really, really cheap? Yeah. Time spreads. Time spreads are diagonals or calendars. Okay. Not really an iron condor. No, when vol is cheap, we don't want to put on an iron condor, because we don't really want to sell. Okay, we don't really want to sell that volatility when it's cheap. So think about, if volatility is cheap, okay, we want to buy time. That means those options, the further you go out in time, sure, they're going to be more expensive than options that expire this week, next week, in the short run. But because they are more sensitive, the further you go out in time, to a change in implied volatility, there you go. What are your options? Because they are more sensitive, we would rather own that volatility when it's cheap. Let's take a look at NVIDIA here. Okay, let's take a look at NVIDIA. Here is an option chain. I just pulled this a few minutes ago for NVIDIA, and I just randomly took option chain for September a month out. Okay, look at the difference in the in the VEGA. Okay, as we go from at the money here, okay, to out of the money, so moving further away, or in the money. moving further away. Okay, VEGA is highest for at the money options, regardless of the expiration. And the further you move away in either direction, the lower and lower that VEGA component will be. Okay, is that clear to everybody? Is that clear? Okay, now another question before I move on to the next screen here. These are the markets right here for NVIDIA call options. Why don't I also have NVIDIA put options up on the screen? There is definitely a distinct reason for that. Boy, making perfect sense. Wow. An answer like that is awesome. Okay, it does have something to do with call put parity. Okay, remember, no, it has nothing to do, Joan, with buying or selling. It has nothing to do with buying or selling. Remember, call put parity, as who put that in here? Robert and Kevin. What that means is the premium amount or the extrinsic value needs to be the same for both a call and a put at the same strike, same expiration. That's what call put parity means. Okay. See, Robert, you learn something every day. That's why you're here. That's awesome. That's awesome. And Cheyenne, there you go. Haven't seen you in a while, kid. How are you? Yes, VEGA is the same for both a call and a put. Same strike, same expiration. They will move in tandem. Okay, so on my charts that I use, on the chart you're seeing here, which is for live vol, my Thinkorswim charts, just to conserve space on my screen, I only show VEGA on the call side because it is the same on the put side. So if vol is going up, okay, if vol is going up, the VEGA on a call or a put will be affected the same. Does not matter. Awesome. Now, before we move any further, we had a good discussion yesterday about our mascot. And I love Thor, and Thor will be back. But we also talked about Ralph Cramden and the Honeymooners. So I had to bring that in today. Jeff Lake, I hope you are watching. This is my absolute 100% favorite show of all time. Probably followed by the Three Stooges and then Seinfeld. But this is Ralph Cramden. This happens to be from a scene. He's obviously screaming at his wife Alice in their kitchen, which is the only room in their apartment we ever saw. And he happens to be screaming out, "I'm a blabbermouth." So this is a great shot. This is a great shot of Ralphie here. Jackie Gleason, one of my favorite actors of all time. In fact, hate to digress, but I'm going to. How many of you have ever seen this movie? It was very, very late in Jackie Gleason's career and very, very early in Tom Hanks's career. Phenomenal movie. Highly recommend it. It's probably on Netflix. If you got an extra hour and a half at some point, check out this movie. Fantastic movie with both Jackie Gleason and Tom Hanks. Okay, we'll maybe come back to Ralph here. Okay, now we looked at how VEGA affects options within the same expiration, at the money being the highest, and as you move further and further away, it gets lower and lower and lower and lower. But what about over time? Here, what I did, and these are just weekly options. If we looked at a greater time frame and put monthlies here and went further out over time, we'd see even bigger changes. Bill K, there is Smokey and the Bandit was awesome, as all of the Smokey and the Bandits with Jackie Gleason and Burt Reynolds, and man, that was awesome. And Jerry, who played Cletus Snow? Jerry Reed. Smokey and the Bandits, unbelievable. So anyway, we can see here that the further you go out in time, the more effect a change in volatility has. Okay, so right here, this just goes to show us, and this is just a very small snapshot going out just a few weeks, that when vol is really low, we want to own that volatility, because the change in implied volatility will impact those options more. I always look at it and I always talk about, you want to buy something on sale, right? Whether you're going to Costco, Walmart, Neiman Marcus, Nordstrom, I don't care. You always want to get something on sale. Trading options is the same thing. You want to buy options when they're on sale. Okay? That's what implied vol, that's what VEGA tells us. Okay? Somebody mentioned a stock. First stock I see pop up in the chat, I'm going to bring in the charts. Eastbound and down, rolling down and trucking. That was a great song. AMD it is. Jerry Reed's song. And I think I said his name was Cletus. That was his boxer's or his bulldog's name that he had riding in the cab of his truck with him. Okay, here is an AMD option chain. Some bitch. Yeah, love that. Okay, here's an AMD option chain. Okay, now options that expire in just 2 days. If we look at the money, we can see the VEGA is 5.6. Okay, let's look in real time here how a change in the implied volatility affects these options. Was it a Basset Hound, Pete? Thank you. Oh, so it was Fred, and Cletus was Jerry's name. I got it all mixed up today. Okay, let's see how a change in implied volatility affects the change in the price of an option. So let's focus in right at the money here. And we're in a live market, so we're going to see the markets change. Okay, the 185 call is trading roughly 322, 323. Now it's 325 with an implied volatility of roughly 55. Okay, now remember, the VEGA is about 5.5 cents. So that means for every 1 percentage point that I change this implied volatility, we're going to see a 5.5 cent change in the price of that option. So one of the reasons I love this particular platform that I trade on is because it allows me to change vol on the fly to evaluate how an option price changes. So watch the middle here where this arrow is. Now it's 325, 326. I'm going to lower the implied vol by roughly 5 points. I'm going to make it 50.5. We should see the price of this option decrease by about 27 cents. And lo and behold, you can see, let me take all of the other markings off of here. You can see how that changed. Now, if I remove that, okay, now it's back at where it's trading 55 vol or so. If I were to increase it to a 60 vol, we should see the increase value of that option go up by about 27 cents or so. Let's take a look. Watch the price right in the middle of the circle there. That's 328 right now and 355, 27 cents. Okay, that's just a real easy example of how VEGA affects the price of your option. So one of the reasons why when vol is so cheap, we want to be time spreads, okay, is because even though we would be short an option that expires, maybe in a week, 2 weeks, but then own one longer out in time, if vol goes up, okay, more than likely it's going up for both options. We'll lose a little bit in the value of our short option. We will gain a lot more in the value of our long option. All right, Michael, I'm not sure if we are closed on the wheel yet, but this is Ralphie on the wheel today. Okay, are we closed on the wheel, Mike? Augie, thank you. Yes, smash. Okay, the wheel is closed. Okay, any questions here, folks, on VEGA implied volatility? Why time spreads? Time spread meaning calendar, diagonal. Why those are very, very advantageous when volatility is cheap. Any questions? All righty. Kevin, okay. Yes, what is your question? As we speak, Austin Goolsby, one of the Fed members, he is talking right now. I'm just looking at the headlines here. Tariffs are a stagflationary shock. Independence of the Fed is important because we don't want inflation to come back. Data revisions should not be controversial. I agree with all those, actually. I think those are all kind of common sense, to be quite honest. When VIX is low, is it a good buy? Well, let's just take a look, real quick look here before we go to the wheel. Okay, just like we know implied volatility is mean reverting, meaning that when it comes all the way down, we want to buy it. When it's really high, we want to sell it because it's always going to find its mid-level. Well, Augie, I disagree with that, but that's okay. We can agree to disagree. Okay, just like the mean reversion of implied volatility, the VIX is also mean reverting. Okay, it absolutely is. And when I say that, volatility is mean reverting, I'm just going to punch up NVIDIA here again for a second. Here's a implied volatility chart in NVIDIA. Sell. Buy. Probably fair. Okay. All right. Looks like we have our wheel ready to go. Oh, yeah, we got a packed one today. Excellent. 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 All right. Let me type something in here. Okay. Are we ready? Let's do it. All right. Are we going to get an RJ? RDB coming up again. RJ, RDB, RJ, RDB, RJ. Are you in the house, RJ? Do we have RJ still in the house? Oh, RJ, we're looking for you. We're looking for you. Don't make me spin the wheel again. I don't know if all your compatriots want you to acknowledge the winner again, but I'm going to give you 5 seconds and then we're going to respin. 5. Oh! When the pressure was on, he responded. All right. That could be, Bear. That could be. Oh, then that is perfect for today, RJ. Let's go. Let's go. Now, every time I see your name, RJ, this is going to pop into my head. All right, everybody. Again, tomorrow, we are going to have Howard Greenberg to talk about the state of the crypto market with things going nuts. Not just Ethereum and Bitcoin. Yep, we know you're here, RJ. Not just Ethereum and Bitcoin, but it is altcoin season. What the heck does that mean? Howard's going to explain it. And then Friday, I'll be back down live on the floor with a special guest, the Vice President of Derivatives of the CBOE, Henry Schwartz. He is going to be with us. He is going to talk about state of the option markets, zero DTEs. If there is any single person in this industry that has his pulse on the markets, it is Henry. He will be with us live on Friday. All right, everybody. We've got PPI tomorrow morning. Okay, could be a market mover for us. And I appreciate everyone being here, and we'll see you tomorrow.